So good afternoon, everybody, and welcome to the last panel of this morning, Beyond the HLEG, What EU Policy Agenda? Just to save time, I'm going to skip the usual introductions. I'll ask the panelists, who I'm informed will soon include Sven, who's currently in a car on the way from his previous panel, to introduce themselves and perhaps just give us one observation or perhaps one Christmas wish for what they would like to see from the European Commission after the HLEG on sustainable finance wraps up. So I'll start with the person next to me, Sebastian. Would you like to introduce yourself and give us your Christmas wish?
Hi, Sebastian Godinot with WWF European Policy Office. So the Christmas present would be the European Commission to adopt in March next year a very ambitious sustainable finance action plan which would truly deliver functional systemic change, not incremental change. And in our view, that would include 5 things at least: a disclosure package. Maybe actually I should even raise it as a disclosure shock. Redefining the investors' duties, supervisory changes, and work on taxonomies, standards, and labels. Well, there are other issues I'm sure we will discuss. Thanks.
Thank you. Felicia, you are from the Commission, so you can give yourself a Christmas present.
Hi, I'm Felicia Stanescu from the European Commission. I deal, among many things, with sustainable finance. I mean, I would agree that I also hope for a very ambitious action plan from the Commission following the HLEG report. We're planning this action plan at the beginning of March, so we will have some time to digest the final report from the high-level expert group, and I hope that we will be ambitious to put in place the main building blocks, because I think we've heard this morning that we need some very solid building, a very solid foundation to take this work forward. We need taxonomies, we need standards, we need metrics, we need disclosure. So I hope that we can put in place, or at least start a process to put in place these building blocks.
Thank you. Paul.
It seems that we have a similar Christmas wish, but what we need, and this is long overdue, is a comprehensive approach for sustainable finance. And what we see is a financial sector that is lacking. And when I have my Christmas wish, it's not just for March, but also the years thereafter, because it's going to be a huge change, a huge transition, where we have to fight the inertia in the financial sector, push and pull to get it done. It won't be done by just March, it will be a fight thereafter. And my Christmas wish would be is that it could start with this conference, but also in March, that we get momentum for change in the financial sector towards sustainable finance.
Thank you, and with absolutely perfect timing, please welcome Sven Giegold.
We're talking about Christmas. We're talking about Christmas wishes.
No,
let me arrive.
Okay, well, we'll come back to Sven in a moment. Let me ask the first question in that case. I'd like to ask Sebastian from WWF about this idea of mandatory disclosure, disclosing climate and other sustainability metrics, which has attracted a lot of discussion, perhaps inspired by the French Article 173. Can you tell us what this is and why you think this is so important?
Yes. I mean, opacity leads to risks of on the functional stability, and also risks of capital misallocation, because banks, investors, members and beneficiaries are not aware of the risks and opportunities. And this is clearly the case on sustainability issues. Environmental, social governance related risks and opportunities in investments, in banking loans, are not well disclosed. So there are different elements of disclosure which are required in our view. That's why I was mentioning a disclosure package. The first one is to review the non-financial reporting directive. A key enabling opportunity is the FSB task force on climate-related financial disclosure, which is, for the first time ever, as far as I know, is proposing a really consensual framework on climate-related disclosure. So that's really interesting in 4 parts. Interestingly as well, this targets both non-financial corporates and financial institutions. So that includes as well investors, banks, insurers, etc. This recommends as well scenario analysis to have a forward-looking approach. This is absolutely key because the bulk of ESG disclosure is backward-looking, is based on 2-year-old data, and that doesn't tell much of what the companies, what the financial institutions are planning for the next years. So we need forward-looking disclosure. So that's about the direct reporting, corporate reporting, let's say. Another layer of disclosure is to give more elements, more sustainability elements about indices and benchmarks. And this is feasible. There are actually at least 2 different tools already used today in Europe to assess how a given index is aligned with a climate scenario. And for example, a think tank published recently a study for the Swiss market, concluding that in general, the Swiss pension funds and the Swiss insurance companies are investment portfolios. Both public equity and corporate bonds are aligned with a 6-degree pathway, which is not exactly compatible with the Paris Agreement, as you might know. So benchmarks disclosure. Another layer is to have disclosure on retail funds. That's partly related to the indices. It is feasible also at very low cost and with almost automated ways to have sustainability disclosure of retail funds, and that would massively empower members and beneficiaries of pension funds to choose where they want their money to be invested properly. That also requires another layer of disclosures on the bond market, which is more for institutional investors, especially where there's very little information. And we have big concerns about green bonds, where we think it will be impossible to assess the added value of green bonds as long as we have barely any information on the whole bond market, because then the additionality of green bonds is a difficult issue to assess, and we need more data about this. And the last element is to have more disclosure from another key player, which is credit rating agencies, and which do not disclose enough how they integrate sustainability elements into their credit ratings. So there are different layers, and I don't think this is burdening too much, because each time it targets different players in the financial system. So in a way, you really share the burden properly, and you make sure you have a disclosure shock where the sustainability elements become available to all the different stakeholders. Thank you.
Thank you very much, Sebastian. But before I bring Paul in to ask about, speak about investor duties, does anybody on the panel want to respond on Sebastian's points, maybe comment about credit ratings or how we could improve the legislation in that area?
I would say they're good points.
Felicia.
Well, these are also the areas that we are looking at, of course. And I mean, there's some things that can be done and should be done at regulatory level, and there are some other things that can and should be done at supervisory level. So what is, do we maybe we don't need to change again regulation, but there are things that in the way the regulation is applied, because often regulation talks about disclosure of all material risks. Do people really disclose all material risks? Do supervisors really impose disclosure of all material risks, which should include ESG risks or not? So these are things that we are looking into.
Okay, thank you, Felicia. Paul, on investor duties, you probably be aware of the Commission's consultation, which is open until January, on institutional investors and asset managers' duties regarding sustainability. And a lot of civil society advocates are quite keen for investors to find out from their own customers what their non-financial preferences on investment are, whether they want their money to be doing good ESG work as well as making a return, and then to integrate it into their decision making. which seems very sensible as an extension to the idea that people do what their clients want and in their best interest. But is it actually feasible, given that corporate disclosure of emissions and so on, it may not be perfect yet. So how feasible is it to put such duties on finance professionals, do you think?
Well, this is why I would like to underline the point by Felicia that what you need, as I say, you need to start in March, but it will continue thereafter. And what you need is the dialogue, so to say, but a dialogue with a clear commitment on how to standardize the information, but also use this information in investment decisions, financial and non-financial statistics. And to arrive at that, I think you need, you can't lay it down in legislation only, in primary law or in rules. You need also to have the supervisors involved. So first we have to change the mandate for the supervisors. And there are some good examples. I've seen the Dutch Central Bank working with several parties in the financial sector on several issues, trying to come up with a consensus on how to proceed. And this is what you need, because what I've seen, and maybe the Netherlands has been one of the countries that have been a front runner in this area, but I've seen discussions on the taxonomy or the definitions of ESG for many years, and I don't see them converge, right? That's one of the, so I see goodwill, not everywhere, but goodwill, but it needs to converge. And this is where supervisors can play a crucial role. But you need to change in the mandate for supervisors, but the same is true for asset managers. 2 weeks ago, I had a discussion with the large asset managers like BlackRock, and now usually I'm very patient and moderate person, but this time I had difficulty because they were. No, we don't know what our clients want, and we don't know, and they don't ask. So, putting the responsibility elsewhere. They're very good at that, and these are funds with billions and billions, right? Or saying, no, politics should take the lead. There's always someone else that needs to do something except the asset managers. So you need. So I'm rather on the strict. It should be, if you are in that chair and you are an investor, and especially of the larger funds, well, you need to take social responsibility. And of course, this is how I would like to see it. If you want to have this change, and you need to change all the actors in the financial sector, and we should be clear that it's not the financial return or the financial risk that matters. There's more. And that you should try to lay down as firmly as possible.
Thank you, Paul. Maybe this is a good moment to bring Sven into the conversation. Sven, just before you arrived, I'd asked all the other panelists to introduce themselves. Perhaps you don't need any introduction, but please do. And also to express their Christmas wish from the Commission in respect of the HLEG. And then if you wanted to respond to Paul on the investor duties or supervision, please go ahead.
Well, first of all, as I said, I would arrive a bit later because I had another obligation just before, and then you have chosen a room in this square thing which I've never seen before. So to me, this is a mystery building with now proper signs up and so on. So anyway. Myself, I'm an economist, and I have a background in NGOs for a long time, and have been spokesperson on economic and financial affairs for the Green Group in the European Parliament, and followed all the financial reforms, including the setting up of Finance Watch over the last 8 years. And I have to say, some of that we had all in amendments for former legislation and had little support. by a majority in the parliament, and also not in the commission and not in the financial sector. And I feel Christmas in a certain way has already started, because the financial industry now wants suddenly to green the whole sector. I'm delighted, and in the commission many people work on it. I like how this is done in a cross-DG approach, really involving a lot of actors, and it is a bit disturbing that while traditional financial regulation, so look at the ambitions of your report and what you could then win with our colleagues in the parliament, and on securitization. So while generally the mood has changed from regulation to don't do too much on the sector and no more capital requirements, and while the ratio of capital in balance sheets is still often appallingly low in insurance as well as in banks, now when it comes to greening, there's a real enthusiasm. So let's use this energy for the better, while not falling in the trap and believing the financial sector is healthy now and we have done too much, and banks and large insurance company have to be put under nature protection. Yeah? So I think that is my general view. Beyond that, I think we have to be clear what greening finance can do and what it can't do. So greening finance is not a replacement for green legislation. It's quite the opposite. Only if there's green legislation, there will be profitable investment opportunities into which true green finance can invest. That is really the right order of things. And I think it's very important that as environmental campaigners, we don't fall into the trap, because the financial industry loves green finance. We go the easy battle and go with the industry, while we limit our energy to get energy efficiency legislating, phasing out dangerous poisonic substances, greening mobility. And I know from Germany how hard that is. So during the last month, we have had really very difficult battles over coal, over lignite, over dirty cars, the link between these sectors and politicians, and so on. And I spare you the party politic part of it, because we are here in civil society dimension. But this is key, because, and therefore, I think it's important for the sector of finance who want green finance to help us to win these regulatory battles, because only then you will have the investment opportunities. And I'm longing for the moment when DG FISMA will stand up in the commission, when the dirty energy people try to win their battles, to say, you are harming our green finance program because you are now, that is the battle we need, because finance could be the winner of green transformation. It's clear, if you have to invest more, you have more returns on equity. And therefore we can build an alliance between those who want new investment opportunities and those who want the green transformation. And only if we win the substance battles in the different sectors of transformation, energy, mobility, agriculture, and so on, we will have these investment opportunities. And greening finance can help us in order to get a clearer picture of the risks, to price them properly, to have comparability of these risks, and therefore have additional pressure on companies to change investment behavior. But it's not a replacement for the rules for the green transformation. And last sentence I would like to share with you is, we shouldn't fall into one trap. The market is full of capital searching for profitable investment opportunities. I really don't want to see in the final report of the working group all these lobby demands that in order to green finance, you need lower capital requirements for green finance investment. No, we don't need another weakening of Solvency II, at least not as long as we have not sufficient capital in the respective institutions, so that the next crisis they can pay themselves rather than society. And we as greeners should not fall in the trap of some sectors of financial industry that they want some alleviation of capital requirements anyway, and we bring the fine green values in order to justify that. That would be a mistake. And there I'm really careful. We should force everyone to weigh risks properly, to take them into account. We should, and also have transparency and phase them out of dirty investments. But please, we don't have to pay the price to get more financial insecurity as alleviations of capital requirements in return. So that would be my, as usual, sharp intervention on the subject.
Thank you very much, Sven. I think obviously Felicia has to come in and answer some of these points here. But before that, I'm just going to ask Sven if you could very briefly respond on one issue which came up this morning when Olivier Gersant gave an introductory speech, a keynote speech, in which he gave some emphasis on the work going on to develop a green taxonomy. Given that the priority really is to get out of brown, do you think that maybe the Commission's first job should be a brown taxonomy?
Well, I think that the devil is in the detail. So who should do what? So of course the market-driven point of view would simply say, if the brown risks are transparent and everybody is obliged to factor them in, and on the other hand, the green potential in each company is transparent, then the market should do the job to basically factor that into the pricing. Do we need additional elements like greening and browning factors in capital requirements? I have to openly say I haven't made a final decision for myself yet. That will be also be, but I tend to be rather skeptical. I tell you openly, because I simply think, does the state really know better what a risk is? I've always been skeptical over all these internal models, the approval of internal models, where the state claims, I know best what risk is. And on the other hand, I see, at least more or less all over Europe, profitable green investments. They are financed, they find their money. We have regions where we have other problems which are related to the Eurozone governance, which we urgently have to sort out. We have banks which don't function properly, that we have to sort out. But we basically come from the wrong angle here. That would be my first hypothesis. And also the brown factor is sometimes now used in order to justify the green factor. If that would be, I have a certain skepticism towards that whole idea to make capital requirements in what way or another even more complex. I think we need sharp and simple and tough capital requirements, and beyond that, all risks have to be transparent.
Thank you.
So, yeah.
Paul, you were a rapporteur on the STS securitization file. When I read about capital relief for STS securitization, and then I read about the possibility of capital relief for green investments, this sort of monster appears before my eyes of, every mortgage for a house that has a solar panel on the roof suddenly gets a cheap mortgage, and we end up with a real estate bubble. Is this a realistic problem? And if so, what should we do about it?
Well, let me say that in the securitization file, we looked for ways to include ESG, and also thanks to Sebastian, I think we came up with a rather practical approach that you can see the environmental characteristics of houses and cars in the portfolio, so that allows investors to develop a green portfolio, and I think that's a step forward. Can I jump also in on what Sven? I understand the hesitation, of course. Do you want to? You see, might be a confusion between risk and let's say sustainability externalities. You might not want to have that. On the other hand, what I see, of course, this world is not perfect, and as an economist would say, we need second-order reasoning. We're not in and as a politician, I said maybe we should try to push. I understand the hesitation, but I'm inclined to think that you need to make a distinction also between green and brown investment to arrive at this change, because it would be very different if we had a world where we would have CO2 would be, the price of CO2 would be factored in, and in fact, actually it's not. So if you look at the 25 plus years, we have been trying to have a CO2 emission trading system, but it hasn't worked as far. And then you have to question yourself, so how are we going to arrive at change? And one of the changing factors has always been on the supply side. And this is how I see also the financial sector. Can you make a change here? Yes, that's possible. Also, and which I find very interesting at this stage, there is a growing concern about stranded assets. And this is not, let's say, for this audience, but also with ordinary investors that invest in banks and wonder, what is on the balance sheet of that bank? And this is starting to make investors nervous, and this I find interesting. And it means that, let's say, the brown banks or brown investors still, because they want to attract capital, they still need to take the sustainability into account. And this is an interesting change that's going on. And you can, what I have in mind then, is making a decision between green and brown. If we try to let's say, magnify and enlarge the discussion on stranded assets, that would be a good thing, because then we have a dynamic in the financial sector where also the financial nerds will take sustainability into account, because it becomes a risk factor in their analysis.
Maybe this would be a good moment for Felicia to come in. Forgive me, I really can't resist putting you on the spot in this way. So feel free to duck the question if it's necessary. Valdis Dombrovskis, the Commissioner for Financial Services, told the COP23 in Bonn that he supports greening, some form of relief for green investments, and it's a position that's reasonably popular with the financial industry. Olivier Gersant this morning carefully avoided the topic, but he did say at a Bruegel event sometime before that he supports browning, penalising brown investments. So a simple question, what is the Commission line on this?
Thank you. and you've done your research very well. Well,
we pay them for this.
We pay them for this. I mean, yeah, this debate has been going on for some time. It's now emerging with Mr. Simon's report on the CRD CRR package, on the banking package. Brown, so green versus brown. I mean, so there's a question of externality, of course. Are these externalities best addressed through prudential regulation of banks? So that's the first fundamental question. So prudential regulation for banks is there for a reason, which is prudential. So to ensure that banks don't fail and we, the taxpayers, end up paying the bill. But now that takes me to the next question. Do banks assess their risks properly of their investments? So do they take into account all risks? So I think certainly before even we speak about green or brown, and it sounds like I'm dodging the question, but before even we speak about green or brown, we need to look at these risk assessments. So do they take into account properly ESG risks? So do they look, for instance, at kind of climate unfriendly, carbon intensive investments or lending to such companies, industries, and do they take into account climate risk? We don't know. And I don't think supervisors know either, because there isn't a clear requirement for banks to look at these things. So I think that's certainly a first starting point, and that is in the rapporteur's report on the banking package. And then, so do we need a supporting factor, so a prudential factor that either incentivizes lending to green or penalizes lending to brown? I think there the question is, first we need to look, is there more risk from lending to one or the other? In some cases, yes, so to brown, but banks should take that risk into account. Is there less risk from lending to green? Maybe. but the data isn't there and the taxonomy isn't there. So what is green? As Olivier, I think, said this morning, if you start incentivizing lending to green and there's no clear definition of green, everybody will call their lending. So all the banks will call their lending green. So if we do something, and I don't know yet, it needs to go hand in hand with a very clear definition of what green means, or brown.
Thank you. Sebastian, supposing there is some movement on browning or brown penalisation in the new year, we don't know, maybe the Commission will give us a nice Christmas present. Supposing that that agenda at least comes under discussion, I think we could reasonably expect some quite significant pushback from industry on that, and it will be no doubt couched in language along the lines of, don't do this now, there's a carbon price coming, so you'll be double taxing it, and the lights will go out, and it'll be a disaster. Are they right?
So as for the WWF, we have a nuanced position on the green supporting factor and the brown penalizing factor. So far, I mean, we've been discussing with the French Banking Federation that issued this for the first time. So far, we see that the green supporting factor would be a nice present for the banks. It's obvious it's not really evidence-based for the time being. And we are not sure that it would really lead to environmental benefits. So there are different question marks there. So, and at the same time, we see a stronger rationale for brown penalizing factor because there is massive scientific evidence about climate change leading to major environmental, major economic and financial risks. So there is a stronger rationale there in our view. Now, recognizing that tactically that a compromise will need to be found between the different EU institutions on the CRR-CRD regulation review. In our view, the most relevant would probably to integrate in the regulation both the green supporting factor and the brown penalizing factor to have a kind of balance, plus additional enabling conditions to make sure this can make sense, including green and brown EU official taxonomies being currently discussed in the high-level expert group, including as well strong disclosure requirements for the banks using this mechanism. Disclosure again, otherwise nobody will know what the impacts are. Ironically enough, the banks have been modelizing the positive impacts on the environment of the green supporting factor, but so far in discussions of banking federations with the high-level expert group, it was made clear that they have no idea how much money they put in green and in brown every year. The only bank that was able to give a kind of estimate was HSBC France, so a tiny part of HSBC, that asked an intern to do manually a list of loans. This is how it is today. They have not the IT system to know where they put the money. They have no clue, none of them, what is brown, what is green in their own financing. And they use the usual pretext, oh, this is so complex to say if it's green or not brown. But at the same time, they are very good to convince Mr. Dombrovskis that there should be an even lower capital requirement for green, while it is already so low today. So they need to be a good compromise to be found there. One important element, and this is why we push for such a compromise, is that we are in a transition period. So this is disruptive. We have extremely little time to make this happen. And for example, carbon pricing could ideally be enough to make the shift happen, but it's too slow. It's completely, largely to completely irrelevant today. There are lots of market failures all around the place, and we know that. So we believe there is a need for regulatory changes to accelerate the shifts, because very likely betting on carbon pricing will never be quick enough. Even in Europe, which is the largest carbon market in the world, it is now relatively clear with the weak reforms on the ETS regulation recently agreed or being discussed that there will not be credible carbon pricing before 2030. We cannot afford such procrastination, so we need to change something. And we believe changing capital requirements might be one of the options. And I agree with Sven, it might not be the most logical and the most let's say, clean approach. But the urgency is such that if we want to avoid chaos, climate chaos and more, then I think we have to speed up different paths.
So first I would like to note that when we just recently had the battle over carbon pricing, I haven't heard a lot of voices of the banks. We urgently need now this ETS reform, because otherwise we will not invest into green energy or green transition. Isn't that unlogical? Thought about it? So I think that shows one thing, and there I would like to have your empirical evidence when you open basically the box of this. Is it really capital requirements hindering any investment into green transformation? And is it capital requirements which are a significant factor why financial institutions still invest into dirty, or now called brown, energy and the like? I think that if an investment opportunity is profitable, at the moment it gets financed, if the risk return is more or less correct. The underlying capital is not the key factor at the moment. It is perhaps at some marginal projects it makes a difference. But this is not what I hear from industry. And therefore I believe we should be very careful what WWF, Sebastian, what you just said basically is, well, if we don't do this, we, as a replacement for not winning the struggle over the mispricing, then we end up in climate chaos. So you were quite falling short of putting it together in that way. And for this, I have not yet seen proper evidence. And I want to see proper evidence that these sort of fiddling with the capital requirements, that the additional potential stability risks are far outweighed by potential green investment benefits. So, and de-investment, brown or dirty de-investment benefits. So, and that I haven't seen yet. And for this, I would like to see proper evidence.
Sure, Sebastian.
Maybe just to answer quickly, I tend to generally agree with many of your points. As I mentioned, it's not much evidence-based today. So such a compromise would entail some risks that have to be studied. And that's also, I mean, two other points. Second is, that's why I was mentioning there need mandatory enabling conditions to make sure the risks are properly assessed and measured. And third, I agree with you, capital requirements are certainly not the only element for banks or investors to choose brown or green or whatever else. So, I mean, this is where Paul mentioned the need for an integrated approach to reshuffle sustainable finance. And the high-level expert group is working on many other different issues, which I think are absolutely key as well. I mean, there are complementary elements. One of them notably being the lack of projects in different places for lack of capacity, skills, etc. on the ground, which is one of the elements mentioned. It's not the only one. It sometimes can be a pretext as well. But there are different elements that needs to be solved to address this issue.
Thank you. I'd like to open the questions in a moment. So can we make this the last comment from the discussion?
No, please, because I think this is a very important issue. Having spent many years as a researcher, I'm always inclined to look for more evidence, do further research. But I'm not sure that we do have the time. And we can sometimes also not use just the evidence, but also our intuition. We know that we have a problem. We know that we have now currently an investment portfolio that doesn't match up with Paris. It's pretty simple. So we know that it's not about increasing the return on green investment. It's fact that the risk of brown investment is clearly underestimated. That's the whole stranded discussion, the stranded asset discussion. And this is where like I said, the financial nerds get nervous about it, and they already have a reason to do that. And I think we should look get a better way of what is the risk of brown investment, and that of course leads to a penalizing brown investment. This approach I still think is very promising. And we can't just wait for more evidence. I think there is already some evidence. Also, because we don't know always how risk will materialize. It might not be, like we would hope, that it would be a rising carbon price through the years or a higher carbon price. It might be also be very disruptive. That we, for example, just like Germany closed down nuclear plants, we can at one point close down coal plants. And so it might not be a smooth trajectory. No, it might be very disruptive, making it difficult to calculate risk, making it difficult to come up with evidence, because you can't look backwards, you have to look forward. But then again, use your intuition. We're not on a sustainable trajectory, and it will entail risk, especially for brown investment. Let's start from that.
Should we open this up to questions? We've got a few minutes to take questions from the floor. There's one at the front here, and I'll take two more at the same time. And there, I'm on there. So, Anthony.
Yes, Anthony Hobley, Chief Executive of the Carbon Tracker Initiative. I was struck by many of the comments, particularly one by Felicia about the data. And the problem is, and it was touched on previous panels, much of the data and much of the disclosures and much of what the financial markets does is backward looking. And that is the problem. How can you really understand these risks across all sectors if what you have is a system of analysis that is backward looking? You know, we have to develop tools that are forward looking across all sectors that really understand how do those business models cope as we move forward with this disruptive transition, which we're clearly in. It's a technology-driven transition. We just don't know it's going to go fast enough to deliver a stable climate. And we will learn a lot. But we have, you know, the financial markets under the leadership of, you know, the Governor of the Bank of England and the TCFD task force have given us a set of recommendations on how we move to those sort of forward-looking criteria. So why don't we simply just endorse those and adopt those, particularly objective scenarios? I mean, and that's something we at Carbon Tracker are working on, the financials and modeling and the methodologies for how you do that, so you can compare companies with companies on an objective basis. So could we, and we haven't really touched on in this session today, which has surprised me, that the TCFD recommendations, and we see those as so critical.
Thank you. I'll take the other two questions, and then maybe the panelists can respond. Grégoire.
Yes, thank you very much. Grégoire Niodet from Caritas France and Finance Watch board member. I think just on this greening, browning requirement factors, one point is that if we go in this direction, it has not to be measured by internal models. It has to be in very external and fixed by an authority, external authority. I'd like to hear a little bit about other initiatives like the green bonds and all that. What do you think? Is there not a limit to this if it's still in competition with derivatives and index funds? Because you can have good ideas, but if there's still some short-term and very profitable products in competition with this, will it work?
Thank you. And we had one more question here.
Yes, thank you. Guillaume Proche, Better Finance. This panel is also addressing, as we see in the program, ESB labeling and redirecting direct investments. And we're also in support of Finance Watch recommendation to engage more individual investors. But these retail sustainable products must build trust to engage individual investors, which means they must be exemplary in terms of transparency, governance, and investor protection rules. And we are very concerned. I joined recently the French government SRI fund labeling committee to discover that such labels have been granted to funds that are violating MiFID rules, in our view, on several grounds. For example, claiming they are active, but they hug their mainstream benchmark, claiming they will make a difference by using ESG criteria, but actually, as I said, hugging a mainstream benchmark, so making no difference. And in fact, claiming that they have an objective of overperforming this benchmark, but in fact, over at least the last 10 years, having thoroughly underperformed, not even match inflation, without any information and warning to the clients. This is not the way to build trust in sustainable finance, and my question is mainly to the Commission and the Parliament, that in this action plan, this must be tackled as a prerequisite if you want EU citizens as savers and retail investors to jump in. Thank you.
Thank you very much. Felicia, would you like to maybe take Anthony's question on the disclosure, TSFD?
Certainly, it's a very, very relevant question, and the HLEG, the high-level expert group, has debated that question a lot, and we are very. I mean, we supported this TCFD recommendation, so we are fully aligned with what they say and with the need for this very rigorous assessment that looks forward-looking, that is forward-looking as well, not just backward-looking. But the question is when and how to implement it in the EU, because this non-financial reporting directive that you referred to is coming into application next year, so that companies will start report this year, but companies will report next year based on this year's data. So we will have something we initially estimated something like 6,000 companies. We hear now it will be more because of the way member states have implemented, so it may be more than 10,000 companies that will produce their first non-financial reports. So when is the right time? Should we wait for that and see what these reports look like, what the problem is, what the problems are, what the challenges are?
We don't have time to.
And then the next question is, how do we do it? Do we change regulation again? And that takes time, how it's proposed and it's negotiated and so on. Or are there things that can be done again at supervisory level? So these are things that we are looking into very actively.
Thank you. Sebastian, would you like to take the green bond question?
The green bond question, the WWF is working a lot on this. I think there are 2 steps required. First one is to make sure green bonds are truly green. And as you might have seen, there are lots of shades of green and lots of risks of greenwash. And it will grow, it can only grow when the market grows, right? So what we recommend is to have EU official green bond standards and a label, and we are currently discussing this in the high-level expert group. It's not an easy question because there are already some vested interests here and there, but that's absolutely key to provide credibility to the market and also security to the different bond issuers, buyers, etc. That's the first thing. The second thing is the green bond market is a niche, and it would stay. It could stay a niche forever if there is not an objective to green the entire bond market, to some extent at least. And that's the second step, and that's absolutely key. As long as we don't have more information on the whole bond market, it's very hard to assess the added value of green bonds themselves. I'll give you a very quick example. You take a utility issuing 1 billion bonds every year to finance its normal business, okay? This utility, let's take the assumption it's 50% coal, based on coal plants, 50% on renewables, okay? With 1 billion corporate bonds per year, it finances its model. This year, for the first time ever, they decide to issue a big green bond, 500 million. And of course, it's fully focused on their renewable business, okay? And of course, they still need the other 500 million to finance their daily operations, so they issue a normal corporate bond of 500 million. What's the result at the end of this year? They issued a 500 million green bond, fully focused on renewables, and the normal green bond, the normal corporate bond, that will be by definition fully focused on the brown, on coal. So at the end of the year, they have not changed their business model at all. The green bond is completely useless to green their business model. It only refinances the green stuff they already have, and nobody asks them any question about the normal corporate bond that is financing all the rest. because they don't have any tagging on this normal corporate bond. They say, no, it's daily basis. It's really common to issue corporate bonds, and we don't have to report any ESG element about this. So as long as we don't have more sustainability information on the corporate bonds in the whole market, we cannot seriously see what the impact of green bonds are, except in specific, very specific cases. For example, if a company is completely brown and suddenly decide to do something green, then you can see it, but otherwise you can't. So there's a need to have disclosure on the whole bond market as a starting point to assess the added value and the additionality of green bonds.
Thank you, Sebastian. Would Sven, could you maybe very, very briefly answer the question on benchmarks?
On the benchmarks, I would like to say the following. If funds or financial products violate MiFID, that's an issue in itself, should be tackled, of course, but is not an not an issue of ESG, and we shouldn't confuse everything. So therefore, that should be kept separate. If a fund follows simply another indicator and sees no difference, but sold green, then there's something wrong. So that's another thing. So clearly you cannot follow and track another index which is not green and claim then your fund is green. So there must be something wrong. That, of course, we have to watch. What concerns me at the moment is I agree very much with Guillaume that we should try to get these products also to normal consumers, because one part of the effect of greening finance is to raise awareness with normal people. But what concerns me is, and that's a question to the Commission, if I understand correctly, our big achievement to have a delegated act on PRIPS, you now want to withdraw and not finish the work in finishing the details on PRIPS with this delegated act to define what is environmentally and sustainable investment. And I think we would, by that way, prolong the process. Could you enlighten us what will happen now with this delegated act? Many in the room here worked for in order to get it.
The last word, Felicia.
Two things on the delegated act. One is we received advice from the ESAs, and I think the advice is public for everyone to see, where they looked at what a delegated act would add, and they looked at what exists already in legislation, and they see that actually there's a lot that already exists that would, if supervisors applied things properly and rigorously, then that would make allow for better disclosure for these funds of ESG factors. And then the second thing that I want to say is that we thought that a better approach would be a more comprehensive approach, which is why we launched this public consultation on investor duty, so fiduciary duty. So we thought that rather than go at it just in one area through a delegated act, go at it in a more comprehensive way, look at investor duties across the board for asset managers, pension funds, insurance companies, and see there what we can do in legislation to strengthen their duty of care to the ultimate investor, to include ESG factors and risks.
I have to say I'm highly disappointed by ignoring basically the legislative decisions of the Parliament, for which our two groups have worked a lot. I really regard this as obstruction from your side. I'm really angry about it, and it was the first time that European legislation recognized sustainable finance. And it's now your job to come up at what you are legally required to with this delegated act. And then we can do all the other steps later, and we are fully supportive of what you're doing. But you cannot basically say, when it comes to consumers and their information, we do not give details, and financial industry can claim whatever they want as sustainable finance. That is not acceptable, and I would like that to be noted here as an open conflict between our institutions.
I think... Sadly, we are just running out of time now, so I'm going to wrap this up and pass over to Benoit to conclude our conference. It's been a very fascinating discussion. Thank you very much to our panelists. A couple of key points that I hope we'll be able to take home is that as we run out of time on the climate debate, that we don't want to make things worse with green capital relief, but we need to think very hard about disclosure and disincentives on brown, and including on the taxonomy. We need to find a better way to involve retail investors, and above all, to be bold with the Sustainable Finance Action Plan. And with that, I'll wrap up. Please join me in thanking our panelists.
So thanks a lot to all of you to have attended. Thanks a lot for all the distinguished speakers, members of the European Parliament, representatives of the Commission and senior experts. I hope you join us for a networking lunch in a minute. Just a few words of conclusion. Sven just reminded us we shouldn't fall in a sort of trap set by a certain type of narrative we hear today. And he'll then be happy to read our blueprint on sustainable finance, which was issued today. What you see there, we would indeed like this discussion around sustainable finance to be reframed. So 30 years of financialization of the economy have massively accelerated environmental depletion, a lowering of social standards around the world. And so, and the financial sector has not been fundamentally transformed. We still live in an ultra-financialized, if you look at any sort of indicator, economy. And so turning to this sector, which has accelerated the run to a precipice to now help us to avoid it, seems like a peculiar idea. So we need to make it a servant again and put the plan, as was discussed during these three panels, put the planet and people and the economy first again, and then put the financial sector to work, and God knows there's tremendous talent to then make it happen and make it a very useful servant. Now we will, as we said, engage actively in the next steps following the high-level experts group and the communication we expect from the Commission, all the different issues, quite heated issues, which I think is good because they deserve it, that were discussed just a moment ago. But we'll as I just said, we'll put as much effort in continuing to try to help us to get out of this paradigm where we have abandoned direction of the economy to markets. And so we have this tremendous dissonance. So we had Jean-Pascal Van Ypersel, a scientist, reminding us of all these figures, dramatic and quite frightening figures, to be honest, about, I'm not going to remind them. And then we're having this discussion about, so what are we going to do about it? But we do see we don't have this direction. He said at the end of his presentation, we should be able to look in the eyes of our kids 2 or 3 decades from now and be courageous to tell them, you know, what have we done? And so one of the main things, as we discussed, is you have this tap where there's this very toxic product which is going out and poisoning the planet and poisoning people. And so why don't you just shut the tap, right? And because we have no direction anymore, then we find all these crazy ways to go around it to say, yeah, we can't shut the tap, that's too difficult, but so we're going to influence it this way and that way. And of course, a strong carbon price via tax would be, it's already an indirect way, but apparently that's already too complex, so that's not very reassuring. So just to conclude, we call this accelerating EU leadership in sustainable finance. I think it's key to make change happen. I think it's also key because we see that people, and we've seen that in the US recently and definitely in the UK, people will just not take the status quo anymore. And we just had COP23, if you talk to people in the street or when you do your grocery, I'm not even sure if people are depressed about listening on the radio of what was decided or not decided because they didn't believe it was going to bring any change in any way. And so I'm afraid if we don't see the sort of EU leadership we need, and we have quite a few leaders here on this panel and there are others, stepping forward and proposing alternatives and getting out of this paradigm, we might see political characters that we are still for the moment happy to see across the ocean or across the channel to start to take some power in Brussels, which none of us want. So this is why we call for a bold approach over the next few months on EU sustainable finance, but also a new mandate for the Parliament and for the Commission. So a longer-term, ambitious agenda to solve these crucial issues. Thanks a lot, and please join us for lunch.